Welcome everyone to tonight's webinar. Before we get started, let's go through the welcome steps. So make sure that you can hear and see us clearly on your computer, phone, or tablet. Make sure that you can see the little chat box here where you can type in any questions that you may have throughout the webinar, either for Rob or in response to a question that he may be asking. You'll also want to make sure you can hear us clearly as we speak throughout the presentation tonight. So please use the call information. You can dial in by phone with the call-in information that we provided for you in the conference ID, or you can also call in with your phone as well. Welcome to Investing 101. My name is Taryn Katusian, Associate Director of Alumni Engagement for St. Joseph's College, Long Island. I'll be one of your facilitators tonight, along with Paige Carbone, our Director, and Lisa Galasso, Assistant Director of Alumni Engagement. Our speaker tonight is Robert Sturges, Class of 2006 and Board Member of the SJC Alumni Association. Robert received his Bachelor's of Arts in Business Administration and is now a Financial Services Advisor with North Shore Financial Group. Thank you, Rob, for being here with us this evening, and we hope you truly enjoy this webinar experience. We'd like it to be as interactive as possible, so please feel free to ask Rob any questions throughout the webinar that you may have, and if he has questions for you, please feel free to let us know if you have any answers for those as well. Rob will now begin his workshop, and he'll be taking questions throughout the webinar as well.
Thank you, Taryn. I want to start off by thanking everyone for taking the time out of their day to join us this evening. As Taryn had said, my name is Rob Sturges. I'm a financial advisor with the North Shore Financial Group, an office of MetLife. I'm here today to give you a general overview of investing and investment concepts, as well as the terminology often used in the financial services industry. It's critical for you to be knowledgeable about money so you can make informed investment decisions, because today more than ever, the choices you make can have a big impact on financial security of you and your family. First off, we're going to review the agenda for today. First, we will be covering saving versus investing and what the differences are. We will then move on to the basics of investing, which include cash, bonds, and stocks. We'll also talk about mutual funds and finish up with asset allocation. Before we get started, I just want to know if there's any specific goals that anyone has or they're hoping to get out of today's session. If there's anything you would like, if you would mind typing in the chat box, Taryn will help in making sure that I cover everything.
Rob, while people are trying to type in their questions, the first question that we actually just had on Twitter was, when is the right time to invest? So that was kind of just a question we got right off the bat.
Sure. Again, the right time to invest, I would say as soon as possible. Depending upon what your goals are, each goal has a different time frame, therefore will structure what your investment should be. Short-term goals such as saving for a wedding or buying a house might structure your investments or savings a little differently, whereas a more long-term goal for those of you who are in college or just graduating, retirement is obviously 30 or 40 years. It's never too soon to start investing and to start saving for tomorrow. With that being said, we're going to move on. First and foremost, what is the difference between saving and investing? When we think of savings, we usually think of putting money aside in a very safe place, where we can get to it quickly and easily if we need it. An example might be a bank account. When we think of investing, it means putting aside money in an effort to get higher returns, such as buying stock. We're going to take a look at some investment options a bit closer. To give you guys an idea, I kind of briefly went over it before I started. When you're looking to save, again, you're looking more short-term needs, planning a vacation, saving for holidays, or even buying a home if you're looking to do so in the near future. When we think more of investing, we're thinking longer term. You just recently had a child and you want to start saving for college, or you want to save for retirement knowing that it might be 30 or 40 years in the future. Many of you have heard this before. There are three major asset classes: cash, bonds, and stocks. Each class has its own risk and return characteristics. When I say the word cash, I'm assuming most of you are thinking about the paper cash that is in your wallet. But when it comes to investing, the term cash and cash equivalents also refers to liquid assets. They are relatively safe, highly liquid, fixed-rate investments such as short-term securities issued or guaranteed by the federal government. Examples include savings accounts, CDs, and treasury bills. Investors generally use cash equivalents for stability of principal and high liquidity, meaning you can turn your investments into cash quickly and easily. As an aside, many experts recommend having at least 6 to 12 months of living expenses in cash or cash equivalents. However, cash equivalents may have trouble keeping up with inflation. Inflation makes everyday items more expensive over time. It can eat into your future investment earnings if the growth rate of your cash equivalent is fixed for a period of time. This slide is going to give you an idea of inflation in action. Inflation has two effects that can take a bite out of your savings over time. What a dollar buys today will only be worth 31 cents in 30 years. And that item that cost a dollar today will cost over 3 times that in 30 years. As prices go up, the value of the dollar will simultaneously go down. What I'm saying is that not only will things be more expensive, but every dollar will buy less than it does today. But how can that affect an investment? I'm going to ask each of you just to take a look at the 3 pictures here. What this is telling us is that it's not easy to outpace inflation and taxes that it is possible to be too conservative with your investments. A CD is a pretty common investment vehicle, but in 2 out of our 3 time periods, the CD owner had a negative rate of return. Before I move on, are there any questions with regards to what I've discussed or this slide in general?
Rob, we have a question from an alum. They really want to know, what is the best option for someone who wants a long-term investment without a lot of risk? Is there such a thing as no risk or little risk?
Of course, there are things that are low risk and no risk. The thing is that while you may not be at risk at losing your principal, as inflation in the slides we just went over, you are at risk of not saving enough because relatively low or no risk investments have a very hard time outpacing inflation. We will get into bonds. We've discussed some cash equivalents. They tend to be the most minimally risky investment options. But again, for someone who just graduated college and is going to be working from their early to mid-20s to their 60s, just getting by may actually be more risky than actually risking to lose in the stock market because of the cost or the lack of growth that you may experience.
So, Rob, when you say low-risk investments may not outpace inflation, you're basically saying that the lower the risk of the investment, the lower the opportunity for you to make a significant amount of money on that investment. Is that correct?
Correct. Obviously, they say no risk, no reward. This isn't gambling. There should be strategic plans put in place that we take into consideration your goals, what you're working with, and what your risk tolerance is. We don't want someone to be uncomfortable with where their money is, but we would like people to understand that in order to make sure you are accumulating enough for the future, some risk may need to be taken to ensure you hit your end goal. We will get into, as we go through this presentation, we will get into the different forms of investments. Some will allow you to take risk and incur less volatility than other investments, while some are strictly just gambling, if you will. So again, if a portfolio is structured properly, you can try to limit your exposure or your risk while hopefully gaining a return that is going to set you up and accomplish the goals you're hoping to achieve. Are there any other questions at this point before I move on? Okay.
Not yet, Rob. You can feel free to proceed.
Now we're going to move on to our second asset class, bonds. You may be asking, but what exactly is a bond? A bond, often referred to as a fixed income investment, is very different from a cash equivalent. Simply put, bonds can be considered IOUs. When you buy a bond, you are essentially loaning money to a corporation or a government. The bond is a certificate that promises to repay this loan with a set interest rate over a fixed period of time. There are many different types of bonds, based on the length of time until they mature or the issuing entity or government. These include short-term, intermediate, or long-term bonds, U.S. government, corporate, municipal, and international bonds. When investing with bonds, there are 2 primary risks: interest rate risk and credit risk. Interest rate risk is the risk that affects the value of the bond investment and occurs when interest rates change. When interest rates fall, bond prices rise. and when interest rates rise, bond prices fall. Changes in interest rates in the U.S. or the world may reduce or increase the market value of a bond you hold. Interest rate risk, which is also referred to as market risk, increases the longer you hold a bond. This is especially important if you do not plan to hold the bonds until maturity, but instead buy and sell them in the open market. As I said earlier, a bond is essentially an IOU, so credit risk does exist. It is the risk that the securities issuer will not pay the interest, dividends, or principal that is promised to pay. Finally, bonds are generally less volatile than stocks because most of their returns come from contractual income payments, which are a far more predictable source of return than price appreciation. When you think of bonds, a lot of government entities will use bonds to raise capital for local projects, whether it be to build infrastructure. Think of like bridges when they try to build bridges or roadways. A lot of companies will use bonds as a way to raise the money with the promise of a certain interest rate each year until the bond matures.
Rob, we have a question from an alum about bonds. So bonds are typically something that a lot of people will give a child on their birthday or, for a celebration when a baby's born. Are those the types of bonds that you're thinking of? And if so, is that something that is good for someone to give?
The bonds that you're talking, a lot of those are like triple E bonds that tend to mature at a certain rate, or like treasury bonds. It is similar. That is issued by the government. A lot of times when you look at investing, you can utilize those as a part of your portfolio, but a lot of times people will look to buy bonds based on corporations or municipalities looking to raise money. As I mentioned, there are different degrees and different variations of bonds, both whether they're from a time period, as we're seeing on the screen now, or from, again, the issuing or creditor of who is issuing that bond. I know in years past, the triple E bonds were very big, but that's when interest rates were much higher and paying out a lot better than they are today. They're not as attractive as they were in years past because of the low interest rate environment we are in currently. Another factor that is associated with a bond's risk is the maturity of the bond. Maturity refers to the length of time until a bond's principal will be repaid to the investor. We can see on this slide the basic classifications of short-term, intermediate, and long-term bonds. The longer the bond's length of maturity, the riskier it tends to be. This is because the longer it takes for the bond to repay its principal, the greater the chance that an unexpected event in the marketplace may negatively impact its value. For example, interest rates and economic outlook can affect bond prices, or the company that issued the bond may fall onto poor economic times. Because of this additional risk, investors are usually paid a higher interest rate for the longer period of time. That basically covers my brief discussion on bonds. I know there were some questions asked. Are there any more questions regarding bonds before we move on to stocks?
I think you can move on, Rob.
Great. A stock is a certificate that gives you partial ownership in a company. With equity investments, you are generally one investor among many who hold a fraction of ownership in a company. Equity investors can typically profit from their investment in two ways: by receiving dividends issued by the company and/or by benefiting from an increase in the value of their shares. Conversely, investors also suffer when the value of the company's shares decrease in the stock market. There are different categories of stocks. They are generally categorized by a company's market, such as small, mid, or large cap, and whether it is a U.S. or international company. The main objective of stocks is growth for the investor. As an investor in stocks, you benefit from how well the company does in the stock market. If the company excels, the stock price may go up, therefore creating positive returns on your investment. Conversely, if the company does not fare well or the overall market drops, then you may face a loss. This variability is called market risk or volatility. Volatility and the fear of loss understandably makes most investors uncomfortable. This is exactly why we generally see higher returns for more aggressive asset classes, like stocks, than we do for more stable assets, like bonds. We'll be able to see this a little bit further on the next slide. What is this chart really showing us? Although stocks are volatile, history shows that they outperform other asset classes over time. If you were to look at any time period on this chart, you are going to see that the stocks almost always tend to outpace bonds, cash, and inflation in any given period of time. When discussing markets, you may have heard that there are two types of markets. They are either a bull market or a bear market. What's going on in the world economically and politically may encourage or discourage potential investors and, as a result, affect the markets. Generally, stock and real estate markets do well when the economy is growing. Tax cuts and low interest rates, a high employment rate, low inflation, political stability, and increased corporate profits have also been generally associated with rising stock values or a bull market. However, none of these factors guarantees that the price of any particular stock or stocks in general will increase. Any stock has the potential to decrease in a so-called bull market. A bull market could last for as little as 1 quarter or as long as several years. For anyone who has paid attention to the stock market has known that we were in a nice bull market from 2009 until recently. That was showing a lot of returns in the stock market, and a lot of people are doing very well on their investments in that time period.
Rob, we have a question from an alum, about bull and bear markets. So if, like you said, if you have stocks in a bull market and they're doing well, and all of a sudden they're not, and maybe there's a potential or the risk has increased, should you pull your money out of the market or not?
Again, there's no blanket answer to any of those questions. All decisions on your portfolio should be based upon what your goals are. And again, what your volatility or your risk you're willing to take is. If you feel that you're doing stock picking and trying again to go along that gambling rate, yes, if you think a stock has hit its max, it makes total sense to try and get out of that stock or of that equity and just take advantage of the gains that you're experiencing. If you're investing for something and you cannot afford to lose what you have accumulated, it does make sense to try and scale back your investments when you're dealing with this bull market. However, if you are talking about retirement savings and something that is 20, 30, 40 years down the line, it could be a little bit foolish to just jump ship if you think that the stock market is at a high, because as we've seen in the past, every time we have a high market value, when the market tends to pull back, we ultimately wind up meeting that last number and then exceeding it. So you have to take all these variables into effect or into consideration when figuring if holding that security or investment makes sense or moving it to something that might be less volatile in the event of a bear market. Are there any other questions before I move on?
Rob, we just had someone ask, what is stock picking?
So stock picking is, instead of trying to build a portfolio that is set up based upon your risk or what your asset allocation should be, which is something we will get into a little bit later. Some people try to play games with stocks based on what they think the earnings reports may be. That's a lot what stockbrokers will deal with. If you think that there is going to be some type of approval for a company that is trying to get a patent or FDA approval, you may try to invest in that specific stock because you think favorable reports will drive the price high, allowing you to sell shortly for a profit. That's something that I don't recommend and don't get involved in. I believe more in setting up portfolios that are built for the long run and that are set up based upon what your goals are and, not, for lack of a better phrase, gambling and putting all your money on or all your chips on black, if you will.
Thank you, Rob.
No problem. As is with life, all good things can come to an end. Bullish markets eventually stabilize, bringing feelings of anxiety, denial, and even fear. When markets start to fall, we are susceptible to despair, panic, and feel a desire to give up. Many people feel dismayed and begin to question why they started investing in the first place. A bull market cannot be sustained indefinitely, so a bear market usually follows. A bear market is typically a period of retraction. Bear market indicators include a slowing rate of earnings growth, high inflation, and high interest rates, increased consumer debt, and climbing unemployment. As we went over bull and bear markets, there are also, as we get into bear markets, there are different types of downturns. The downturns that we'll briefly discuss are corrections, speculative bubbles, and crashes. Has any of you ever heard of any of these terms?
I think we've all heard of crashes, but a few alums are saying, no way, they've never heard of them.
Okay, good. So a sudden drop of 10% in the major market indexes, such as the Dow and the S&P 500, is considered a market correction. After a correction, stock prices tend to move in a different trading range downwards. As an investor, you may not be happy about the decline in stock values that a correction brings. Keep in mind, though, that although past performance is not a guarantee of future results, the market sometimes rebounds quickly after a correction. What happens if the market continues to drop? If we have a sudden drop in stock values of 20% or more over a short period of time, accompanied by widespread selling, this is known as a crash. The U.S. experienced two major crashes in the 20th century, a 23% fall over 2 days in 1929 and a 22.6% one-day fall in 1987. Many of you may remember June of 2008, U.S. stocks tumbled, sending the Dow Jones Industrial Average to its worst low since the Great Depression, as record oil prices, credit market write-downs, and a slowing economy threatened to extend a year-long profit slump. A lot of times what people do is, again, you had asked questions when there's a bear market or a bull market if they should get out of their investment. As I will continually say, each person is different, but on March 9th of 2009, when the market bottomed out, to now we went from the lowest from the Great Depression to hitting all-time highs. So a lot of times if you have the ability to hold that investment and stick through it, it actually offers a very good time to invest. And the reason being is, just like regular purchasing, the market at the time of a crash is on sale. If the value of something went down 20%, then if you're able to invest more as the market tries to correct itself and comes back to where it was, you're actually going to have a better rate of return because of the fact that you were able to buy something at such a low price. The last type of market downturn we'll briefly touch is a speculative bubble. It basically just occurs when overly optimistic investors drive stock prices to unsustainable levels. A lot of people put the 1990s in this category. You can even look back to 2007 when real estate hit unattainable values, and as such, because people were speculating on the value of this and over leveraging themselves with mortgage, it led to a speculative bubble. As with most bubbles, the bubble bursts and investors begin to sell, and as a result, stock values plummet. Although it may take a long time and there's no guarantee it will happen, stock prices are supposed to readjust to levels that more accurately reflect their values. The good news is, as I mentioned earlier, speculative bubbles may offer long-term investors an opportunity to buy good quality stocks at lower prices. This is more of what you should do if the stock market drops. When the portfolio you were counting on for your retirement gets caught in a bear market, it pays to be disciplined and wait for the market to rebound. While past performance is no guarantee of future performance, historically the stock market as a whole has always recovered from its losses. Of course, there is no guarantee that any particular stock or other investment will always rebound from a bear market. Be sure to carefully consider your choices before shifting investments. Sure, it would be great to know when stock prices have peaked so you can sell at a profit before a downturn, but so far no one has figured out a market timing strategy that works 100% of the time. If you decide to get out of the market, you could miss out on substantial gains when prices start to rise again. The best strategy for a long-term investor is often to stay invested during periods of falling prices. Historically, the market has risen over the long term, even with short-term drops. Again, because of our relative age and everyone remembers recent events, in 2008 and 2009, when the market were hitting those lows, if people decided to pull their money out and put it on the sidelines and sit in cash, they missed out on some of the best market runs from 2009 to recently. So again, it makes sense to reevaluate your portfolio and remember what the end goal is and try not to invest emotionally, but instead doing it from a logical standpoint based upon where you feel you need to be and what you feel will get you there quickly.
Rob, I think what you just said makes so much sense, especially when, like you said, there could be a downturn and there's a potential for people to lose hundreds, if not thousands of dollars. Being strategic, knowing what your goals are, knowing what maybe your short or your long-term goals are for your investment. I think that's an excellent point, and thank you for sharing that with us.
No problem. One thing, again, when it comes to investing, you may hear people discuss or call something a paper loss. When you look at your retirement statements, if you're not planning on touching that asset for 30 years, then if you lose 10 or 15% on that asset, again, you really haven't lost anything because you weren't planning on touching that money anytime soon. You have plenty of time to recuperate what's lost and hopefully gain and grow from that point. What we're going to look at now is how to stay focused when your stocks drop. Depending on your age and stage at which you are investing, this slide can also help you understand the best ways to cope during a turbulent market. With today's advances in healthcare, it's possible for retirement to last 20, 30, even 40 years or more. If you are within 7 years of retirement, your strategy should still continue to provide for growth while providing a fair degree of stability. It's hard to estimate how much you will truly need in retirement, but it's important to try and anticipate income and expenses to ensure you don't fall short of your goals. Failing to properly plan the timing and the amount of distributions can trigger significant tax consequences. Carefully analyzing your retirement distribution options well in advance can help you avoid unnecessary taxes and penalties. Although still focused on long-term growth, an investor with 15 years or more until retirement may establish a strategy that provides the potential for growth of capital combined with some more conservative bond investments. Once you have saved the maximum in your retirement plan account, you may want to save even more in IRAs. IRAs offer another tax-deferred way to save and invest for the future. Before we shift gears and move on to mutual funds, are there any questions about what we've gone up to this point, things I've recently just said?
Rob, there's a question from an alum here who, in terms of stocks or even bonds, but really more in terms of stocks, should people set up investments or start investing in stocks for something like a baby on the way or for their child's education?
You know what, you could, depending on the stocks you choose, there are some stocks that offer great value. You could look at some type of dividend-paying stock, a company like GE, one that, while you may not see large fluctuations within their market price, the fact that they are strong in paying dividends to stockholders can provide income, may work as a tool for that types of savings. When you are serving or looking for specific goals, I tend to look more towards mutual funds as opposed to individual stocks in planning purposes because I feel it offers more diversification and protects you a little bit more from being overly invested in one specific company. Again, for anyone who's heard of Enron in the past, that company, people were putting all of their money in their 401ks into that stock, and when that company was found to be doing fraudulent activities and went under, people lost everything. With a mutual fund, which we will get into, you're actually holding multiple stocks, which will allow you more diversification amongst multiple companies. So if one company is suffering a bad time period or not earning what they hope to, another company will be able to pick you up and hopefully still give you positive growth. If you are saving with a baby on the way, depending upon the needs, I would recommend some cash equivalents. If you're looking for college savings, there are college savings vehicles that will offer tax-favorable investments to help you for that long-term growth.
Rob, we have a question here from Michael S. He wants to know what determines the estimated time frames on the slide. He says, is it experience or something else?
I apologize, I missed that. What is the question?
Sure. So the question is from Michael S., and he would like to know, with reference to your slide that's up right now, what determines these estimated time frames? Is it experience or something else?
It's more just giving you a general overview that the shorter or the closer you are to said goal, that's when you really need to start to adjust your strategies. It's not that 7 years is the actual number. It's just if you feel that you're looking to retire within the next 7 years, you truly should be looking to make sure that your investments are set up in a way that is conducive for you meeting your goal in that time frame. It's really tough to look at a goal that's a year away and have the ability to make significant changes to make up for a shortfall. So they want you to try to be proactive, and it kind of is just a general number. The reason they use 15 or more is because a lot can change in 1 or 2 years. A lot more can change in 15. So it's trying to show you more of a short-term investor compared to a long-term investor, so you can kind of get into the right mindset to be able to deal with what's going to happen if your stock drops. Did I answer your question?
Absolutely. Michael says thank you. And if Michael, you or anyone else has any additional questions about anything Rob has covered, please feel free to enter them in our chat box.
Okay. What we're going to do now is I briefly touched on mutual funds. We're going to go a little bit more in depth about mutual funds and how they work in terms of people's investment portfolios. As I briefly touched on, a mutual fund is an investment company that continuously offers new equity shares in an actively managed portfolio of securities. It is an investment that pulls money from many different individual investors like you. Professional portfolio managers invest these pools of money in different asset classes according to the investment objective of each particular fund. By diversifying or spreading their investments among many different securities, mutual funds can help limit exposure for the loss of any one of them. All shareholders participate in the fund's gains or losses. The shares are redeemable on any business day at the net asset value, making them extremely liquid. As I briefly said before, mutual funds actually make up the primary investment choice in a majority of corporate 401k plans, and the reason being is because they are diversified and they hold positions or stocks of many companies. It allows you to kind of limit your risk or your exposure to one company not doing well, thereby affecting you negatively in your investment. There are 4 basic types of mutual funds. They can be classified as stock funds, balance funds, bond and income funds, and money market funds. Within each of these categories, the fund types can be broken down even further. It's important to understand the characteristics and objectives of each fund type so you can maintain a balanced portfolio. Just want to make note that money market funds are neither insured nor guaranteed by the FDIC or any other government agency. Although they seek to preserve the value of your investment at $1 per share, it is possible to lose money by investing in a money market fund. When looking at mutual funds, there are 2 types of investment strategies, active and passive. Actively managed funds are trying to outperform a specific index. The manager is actively researching different investments to determine which will outperform their peers on a regular basis. An actively managed fund will typically have higher fund management expenses than an index fund. Passive investing tries to mirror a specific index, like the S&P 500. Typically, a manager of the fund will invest in the same securities of the index. The fund management expenses associated with this type of investing are typically lower than actively managed funds. When you do your investing, it is important to look at fees inside that, but I strongly advise that you do not put too much credence in what the fees are. And the reason being is a fund can be very inexpensive, but may not perform as well as a fund that costs more. You really want to look at what the net returns are, because in some cases, paying for an actively managed portfolio or fund could provide a better rate of return than just trying to go with whatever the low-cost alternative is.
Rob, there's a question here. It says, how does the stock market affect a mutual fund versus a stock?
The stock market, again, it's a little bit different. In up markets, a stock and a mutual fund can be down. The biggest difference is that when a stock is specific to that one company. So if you're going to invest in Apple, and Apple is having record sales, and their company is growing and everything is great, that stock is going to perform well. Conversely, if sales aren't meeting expectations, they're having a loss, they're subject to litigation, or there's bad press or bad press for the company, that one stock could potentially go down. Now, if you were to have Apple as part of a holding within one mutual fund, that one stock could be down because of all of the things I just recently mentioned, but the other funds or other holdings in that portfolio will actually hopefully outpace and perform well to offset that loss. Conversely, one stock may be more likely to be hit by a down market than if you were to try and go across multiple industries. So instead of investing solely in tech, if you're dealing with large cap companies, you might have a company like Apple, but you may also have a company like McDonald's. And if technology is being hit, but the fast food industries are growing, that is kind of where a mutual fund will hopefully limit your risk compared to holding those individual equities of each company.
Thank you, Rob.
In active investing, there are three distinct disciplines an investment or portfolio manager uses to choose securities: value, growth, and blend. Value funds tend to look for stocks that are temporarily out of favor and may be deemed as underpriced. A lower price may signal a good buying opportunity for the fund manager. The theory of buying low and selling high is at work here. Growth funds, as the name suggests, is you're looking to invest in a fast-growing company. Perhaps a company has just come up with a new patent or receives higher revenue projections. Growth funds are more risky than value funds, but have the potential to yield higher returns than either value or blended funds. Using this style, the manager may be looking to buy high, but sell even higher in the future. Sometimes a manager may invest in funds with a combination of value and growth investments. These are known as blend funds. Blend funds can range from conservative to very aggressive, so you should look at the fund's holdings to make sure if a blend fund is right for you. You should also read the prospectus for whatever fund you're considering, because the prospectus includes more information about fees, charges, expenses, and the risks of investing in a mutual fund. One other thing to consider when looking at a mutual fund is that if you have exposure to a large cap fund with a company like BlackRock or a large cap fund with like a company such as Oppenheimer, while you have funds with two different companies, it is quite possible that the investment managers are investing in similar companies, and therefore you may be oversaturated in specific companies even though you're investing with two different companies. It does make sense to try and know what the holdings of the mutual funds are to make sure that you truly are diversifying your portfolio. Speaking of diversifying, the next topic we're going to discuss is asset allocation strategy. Have any of you heard about asset allocation? Is it something that you've discussed?
Everyone's saying no, Rob.
Okay. What asset allocation really means, it simply is diversification. In one single sentence, don't put all your eggs in one basket. This is the foundation for asset allocation. Asset allocation helps investors reduce risks, achieve more consistent returns, and decrease volatility. Asset allocation is really a simple strategy. By spreading out or allocating assets over several different investment types or asset classes, the same market forces that may cause some investments to lose value over a certain period of time may cause the value of other investments to increase. Viewed over the long term, your savings can truly benefit from such a diversified mix of investments, options, and styles. In other words, by diversifying your investments, you can take advantage of a wider range of opportunities. It also means you are never exposed to the risks of just one investment. While diversification through an asset allocation strategy is a useful technique that can help manage overall portfolio risk, excuse me, sorry, I apologize. There is no certainty or assurance that a diversified portfolio will enhance overall return or outperform one that is not diversified. An investment made according to an asset allocation model neither guarantees a profit nor prevents the possibility of a loss. When being successful in investing, you require setting goals. You need to evaluate the options available and understand and manage risk. How successful you are will depend on the choices you make. It is important to take a holistic and long-term view of your personal situation, such as when will you need the money? Will you be starting a family? Are you thinking about buying a first or second home? Also, equally important is to determine how sensitive you are to certain risks that are inherent to investing, such as inflation or interest rate risk. Does anyone have any questions up to this point?
So there was just a question, and I think you covered this a little bit, but if you could just kind of explain it again. So the question was, who would be best suited for a short-term investment, and is there such a thing?
So short-term investments are, a wedding. If you want to buy a house in the next 5 years, if you are saving to buy a car, it really depends upon the time frame. So again, depending on when you're getting married, maybe you have, 2 years that you've got engaged and you plan on having a 2-year engagement. You can afford to try to invest in, maybe some, short-term bonds or some more stable stocks because you don't want to take the risk of, losses based on a very volatile investment. Same thing with buying a house. If you're currently in an apartment or living at home with your parents and you know that you'd like to buy your first home or move on to a bigger home in the next couple of years, those are all goals that are short-term. Long-term, you just had a baby and you have 18 years until college. You just graduated college and you're just starting out and you want to retire in 35, 40 years. Those are more of the long-term.
Thank you, Rob.
Okay. Most important of all is actually to create a long-term financial plan. Although everyone's situation is unique, there are some important components of a financial plan you might start thinking about. Retirement savings programs are at the top of the list because so many of us of all ages are concerned about this. You might want to consider programs both inside and outside of your company plan. Other considerations are after-tax investments and life insurance. Do you have enough? Most people do not. If you have children or are planning to, college funding is a critical part of any investment plan. Just ask any parent who has had to pay for college. Finally, for many of us, long-term care insurance should be considered as well. One thing I will say, I'm sure some of you might recently graduated and are dealing with college loans, and I'm sure you would have loved if your parents had put away more money so that you could have gone to college and not cost you anything. But moving forward, I am a big believer that you are best to pay yourself before anyone else. If you have $2 that you can save and you're thinking of putting $1 in your retirement account and another dollar in your child's college savings plan, I would recommend that most of you try to save as much and maximize as much for retirement. And if you're able to maximize or hit the actual contribution limits, any excess funds, I would then try to move into some type of college savings plan. The reason I feel this way is that there are scholarships, there's tuition reimbursement, and there are loans for college education. There are not retirement loans. I would think everyone should try to take care of themselves first, and if they are fortunate enough to have money left over, then look to try to put some money aside for college planning. Is there anything any questions, anything else you'd like me to go over?
Rob, so in terms of, like you just mentioned, retirement savings programs, so for some individuals, maybe now or in the future when they secure a position, some companies will offer retirement savings 401k plans. In the event that you're working for a company that does not have those options, what are the best options that you can pursue as just an individual person to start a retirement savings for yourself?
Sure. As Taryn mentioned, if you are fortunate enough to work for a company that will offer a corporate 401k, and even better, a corporate 401k with a match, that should be the first bucket that you try to put your money into. If, unfortunately, a plan like that is not available, then someone should look to try to open up what's called an IRA. An IRA is an individual retirement account. It is a vehicle that can be funded in many ways. It is basically an umbrella that lets the IRS know that the money inside of this IRA has not been taxed. You can fund an IRA with a stock account, a mutual fund account. You can fund it in CDs. You can, there are many different investment vehicles that you can contribute to that are under this umbrella of an IRA. Currently, in 2016, you are eligible to put in $5,500 per year into an individual retirement account. If you happen to be older than 50, you are allowed to take advantage of a catch-up provision and put away an additional $1,000.
Rob, there's a question here from Michael S. He says, any remarks on factoring in health insurance? I imagine many of us are nearing the age to purchase our first policies for ourselves.
Health insurance, again, we happen to live in an environment right now with the Affordable Care Act where things are different than they had in the past. As a result of the Affordable Care Act, many people are eligible to stay on their parents' plans until age 26. If you are eligible for that, I recommend you do so as long as you can. If you are not eligible for that, first and foremost, try and see what your employer is offering and what type of contribution they are offering towards the plan to see if it is feasible for you to go that route. Finally, if you, again, are under the age of 65, the individual marketplace is available, and based upon what your earnings are, some of you may qualify for a subsidy for your plans as well. Again, that's, health insurance is kind of a tough thing to save for. You have a premium that you have to pay. I don't want to get too in-depth into different types of health insurance plans, but if anyone wants to speak in-depth, I can. There are certain health insurance plans that do allow for additional savings. They are called health savings account, and they typically coincide with high deductible health insurance plans. So it's kind of tough to save up for a payment for every single month. It's more just utilizing the options available to you and making the decision that fits you and what your health needs are. I myself never go to the doctor, so paying less per month for a higher deductible plan may make more sense for me than others. Conversely, if you happen to suffer from some type of condition and need to take a lot of medication or go through a lot of testing, it may be more important for you to pay more for a health insurance plan that limits what your out-of-pocket expenses are when you utilize the plan. I hope I answered or touched on what you were looking for.
Michael says thank you. And thank you, Michael. If you need to clarify that question, please feel free to type another one. And if others have other questions, please feel free to type them as they come to you. As you see, Rob will continue to answer your questions.
Also, if there are any questions that people might want to discuss more personally, I can give you my phone number. You are all more than welcome to call me with any questions. I'd gladly discuss what your situation is and give you recommendations based upon what I feel is best for you. If you'd like, I can be reached at 631-851-5613. I can also be reached via email at rsturges, STURGES, @metlife.com. Just please keep in mind that I prefer to have all conversations over the phone, as there is a lot that can be misconstrued in writing.
Thank you, Rob, for that. And as Rob just mentioned, if you have any specific questions that pertain to you and your financial situation, please direct them to him directly after the webinar or following the webinar presentation.
Also, as I'd like to say, any questions that are brought to my attention personally remain personal. I do not want anyone thinking that any information or any feedback is given to anyone based upon questions that come from this event.
Thank you, Rob. Thank you, Rob, so much for that amazing webinar experience. We'd like to remind all of you to keep the conversation going on the various social media platforms that we have available to you through St. Joseph's College. Right now you're looking at our Twitter page at SJCNY Alumni. You can keep the conversation going, and we can take any questions or tweets that you have for Rob with the hashtag SJCYInvest. We also have our LinkedIn group, St. Joseph's College, New York Alumni and Friends. Please feel free to join us, message us directly on there. We'd love to hear from you. Right here you also see our Facebook page, St. Joseph's College, New York Alumni, and our Instagram page for all things alumni. And this is the first webinar in our Alumni Financial Webinar Series. So you just heard Robert Sturges present on Investing 101. We'll be welcoming Kevin Cantwell for Conquering Debt on July 11th for all things related to student debt and other types of debt, credit cards, loans, and such. We'll hear from Rosemary Klufel from the Fairway Foundation, who'll be discussing the American Dream, myths and truths about buying a home. And then we'll hear from John Johnson in September on retirement planning. So it's a little bit of something for everybody, and they expand on some of the things that Rob was able to touch on this evening. If you're interested in registering for any of these webinars, you can do so by visiting our website at alumni.sjcny.edu/websummer16. We also have our Centennial Concert coming up with Philip Phillips, platinum recording artist, taking place on Friday, September 30th at the Space at Westbury. So please make sure you are on the lookout for that. And if you're interested in learning more, connecting with us on social, we'll now be taking more questions from you if you have them. And we're going to leave our social media handles up and my contact information if anybody has specific questions for me. We will be sending the slides to all of our participants, and we'll be sending a webinar survey as well for you to give us your feedback so that we can continue to improve. But if anybody has any questions for Rob that we didn't cover, please feel free to indicate them now. Okay, Rob, there's a question that says, how do I know if I should choose stocks over mutual funds?
Again, whenever doing any type of investing, you have to look at what your goal for the investment is. I'm a big fan of stocks if it happens to be, money that's, if you will, extra money. You want to play a little bit, have a separate account. That's where you want to kind of play with maybe your biotech stocks, or you want to try to day trade. If you're looking more long-term and you're looking to generate an income, you might want to look at stocks that I had mentioned earlier that are dividend-yielding stocks, stocks that you know that have a very strong path, or past rather, of paying dividends that will provide income for your future needs. If you're looking more for accumulation and for savings and retirement accounts, I am a big proponent of mutual funds over stocks. And the reason being is I want you to be more diversified and not overly saturated in one specific company. If any of you have or work for a company that is publicly traded, you typically will have the ability to invest in your company's stock. Again, if you think it's a good company, I recommend doing it, but I never recommend investing more than 10% of your 401k into that specific company stock. Anytime you talk to anyone about investing, they're going to tell you that there's no one-size-fits-all. It's what is your goal, what is your risk tolerance, and then if you're dealing with someone that knows what they're doing, they will be able to steer you in the right direction. And in most cases, a lot of times will involve mutual funds and stocks.
Thank you, Rob. There's another question. What is the best way to start if I'm a recent graduate and have just started working?
If the first thing I would tell you to do is go to your company's HR department, find out if there's a 401k, and start to contribute into that. If the company offers any type of retirement plan, I recommend that the least amount of money you put in is whatever gets you the maximum match. So if a company will give you 4%, if you put away 5%, I think 5% is the least amount of money you should start off with. I also recommend, if you're fortunate enough, try to increase that every year. If it's 5% this year, make it 6% next year. Try to increase it each year so that you make sure you reach your goal. If that's not available, again, open up an IRA. You can set up IRAs where you can do a direct debit from your bank account and money can be contributed every single month. There's so many different ways. The biggest thing is just either go through some type of E-Trade account to start on your own, or meet with an advisor and start putting money aside now, because that money is going to come in handy later if you're looking to pay for a wedding, if you're looking to buy a house, whatever the case is. The more you can put away today, the more help you're going to have tomorrow.
Another question, Rob, from an alum. So this person wants to know, and it seems like such a simple question, but it seems maybe a little bit more complex. Is it ever too late to invest? This person says that, what happens if, you couldn't start saving for retirement as soon as you wanted to, but maybe you're a little bit later in life and you want to start saving. Is it ever too late?
It's never too late to start investing and saving. It's just you need to come to the realization that attaining your goal may require you to either put away a lot more at that time period because you're working with a shorter time frame, or take a lot more risk to try and get a better rate of return. It's never too late to start savings. I recommend, if you haven't started yet today, start tomorrow, and just make sure that you're reasonable enough to adjust your goals to be realistic and attainable.
Rob, here's another question. So someone wants to know, are there any investments that allow you without penalty or with minimum penalty to withdraw a certain amount of money or all of your money due to, a life situation like you had just said, whether it's a health care issue or a major life situation that you weren't planning for financially?
Any type of outside investment, stock, mutual fund, anything like that, they tend to be very liquid, where you can pretty much sell whenever you want. The one thing to keep in mind, though, is that some mutual funds have charges up front. So, for instance, some may have a front-loaded charge of, say, 5%. If that's the case, if you invest $100 today, only $95 is going into the investment. If you try to sell tomorrow, regardless of the account value or what happened, you are going to be down a little bit. So take that into consideration. But any non-qualified investment should allow you liquidity, with the exception of some others that do offer or hold what's called surrender charges. Conversely, retirement accounts like 401ks do have what are called hardship withdrawals, where they will allow you to access your money for certain needs, such as medical situations and things like that.
If there's any other questions or last thoughts for Rob as we end our webinar tonight, please feel free to type them in. Otherwise, you do have Rob's contact information. I typed it into our chat box, so you could receive that as well. Any last questions or thoughts for Rob before we conclude? Thank you, Rob, so much for your amazing webinar tonight. I know I learned a lot. I think everybody else did too, so thank you.
You're very welcome. Again, guys, if anyone has any questions, please do not hesitate to reach out. I can be reached all the time.
Thank you, everyone. I will be sending the slides, and I will be sending a webinar survey shortly following the webinar for your feedback and thoughts. Thank you, everyone, for joining us tonight, and thank you, Rob, for being our facilitator.